The first thing I did when I started trading was memorize every single candlestick pattern, and it was a massive waste of time because I was still losing money. But after about 6 months of testing, trading, and optimizing, I realized there were 2 candlestick patterns that stood out above the rest, and that these 2 candlestick patterns were accounting for 90% of the profits I was making in my trading. These 2 candlestick patterns performed so well that they're still the only 2 candlestick patterns I use in my trading today. So in this video, what I want to do is show you these 2 candlestick patterns, show you the objective way I have of identifying them so there's no confusion when I'm looking for them on a chart. And I'm going to explain a full systematic strategy that utilizes these 2 candlestick patterns and that I think can jumpstart your profitable trading career. So if that sounds good, go ahead and click that like button for me. Go ahead and subscribe if you're new, and I'll see you on the other side of the intro and disclaimer. Welcome back. And first off, what is the problem with trying to memorize every single candlestick pattern? Well, for starters, you're going to be overwhelmed if you try to do that. And number 2, the reason I was doing that and memorizing every candlestick pattern is because I truly believed I was going to find some magical candlestick pattern that would win 80 to 100% of the time by itself, when the truth is that something like that does not exist. Instead, the way you need to see candlestick patterns is as a small piece to a much larger puzzle. Your trading strategy is that full puzzle. The candlestick pattern that you choose to use is just a small piece of that. So what I would recommend is try to find a candlestick pattern or a couple of candlestick patterns that work best for you, and then incorporate that into an overall strategy, which is the entire process we're going to get into right now, starting with me showing you the 2 candlestick patterns that perform the best for me. For any of you who have studied candlestick patterns, or for most of you who have viewed our content, this is going to be review. So I'm going to go through this rather quickly. Essentially, my 2 favorite candlestick patterns are the bullish and bearish engulfing pattern and the hammer/shooting star pattern. Now I'm going to go over my objective rules for spotting these patterns with you. So for a bullish engulfing pattern, it's super simple. We're looking for a red candle followed by a green candle, in which the green candle has a larger body than the red candle. That's a very easy way to define an engulfing candle. And in the Forex market, the close of the previous candle is going to be exactly where the next candle opens a majority of the time, which is why I'm not saying that we need a lower open on this engulfing pattern. That may be something you've read about. But for a bearish engulfing pattern, we're looking at exactly the opposite. We would look for a green candle followed by a red candle that has a larger body than the green candle. That would be our bearish engulfing pattern. Now, as for the hammer and shooting star, I have a very specific way that I spot these patterns to make it objective. So I'm never confused about asking myself, is this a hammer or is it not a hammer? Is this a shooting star or not a shooting star? And that way is by using a Fibonacci retracement. And I just pull from the low of the wick to the high of the wick. And I want to ensure that the entire body of the candle is above the 38.2% retracement. As long as that is met, and as long as that is true, I have a valid hammer candle. And then also for a shooting star, it's exactly the opposite. I'm pulling a Fibonacci retracement from the high of the candle down to the low of the candle, as long as the entire body of the candle is below the 38.2% retracement. I have what I consider a valid shooting star. The color of these candles does not matter. This could be green and this could be red. Now that you have my 2 favorite candlestick patterns and the objective rules I use to identify them, let's move on and talk about a systematic strategy that utilizes these 2 candlestick patterns plus other confluences in a strategy that I think can help kickstart your profitable trading career. One of the key components to a successful trading strategy is that you have rules for every aspect of that strategy. This strategy specifically is going to be a trend continuation strategy. So the first rule we're going to talk about is our trend rule. For trend, we're going to be using the 20 EMA and the 50 EMA. When the 20 EMA, which is my red line, is above the 50 EMA, which is my blue line, we're going to consider that an uptrend and be looking for buying opportunities. And the opposite is true as well. We're also going to be combining trend with areas of value. As you can see right here, we have our areas of value. The first area of value we're going to be using is the moving averages themselves, which can oftentimes act as support or resistance depending on the direction the market is moving. The second area of value we're going to be using is the stochastics indicator, and we're going to be looking for extremes on the stochastics indicator. An extreme for the stochastic indicator can be seen at the 20 line and at the 80 line. If this blue line is above the 80 line, then we're in an extreme overbought area. If the blue line's below the 20 on the stochastics indicator, we're in oversold territory. We'll be looking for buy trades and oversold and sell trades and overbought. The third area of value that we can look for is support or resistance within 100 candles looking left. Now, if you look beside areas of value, you can see that we need at least 2 out of 3 of these to occur. So we're going to be looking for at least 2 out of 3 of our areas of value to occur, while price is also in trend defined by our 20 and 50 EMA. And then you already know the entries we have, which are the 2 we've discussed throughout the video already, the bullish and bearish engulfing bars, along with the hammer and shooting star bars. Stops, to keep things simple, are going to be 1 X ATR. The ATR indicator is right up here. It can be found on most trading platforms, and it measures the volatility of the market by giving you the average movement of the last 14 candles. So we're going to be using the ATR below the entry candle. We're going to be going 1 times the ATR indicator below and above the entry candle, depending on the direction that we're trading. Targets are going to be a 1.4 to 1 reward to risk ratio compared to our stop loss for these examples. If you want to take a screenshot of this so you can follow along, that would be great. And essentially the process I'm taking you through in this video is showing you how to build a trading strategy. An acronym that I created that has helped a lot of our students in the university is something I call CEST, or C-E-S-T. If you've been around the channel for a while, this is probably a review, but for those of you who are brand new, C stands for the conditions I need to see before I look for a trade. Conditions would be things like trend and areas of value. E obviously stands for entries that I can take. Why am I actually going to press the button? I don't want to be confused after seeing my conditions met on why I'm actually going to place the trade. I need exact rules for why I press the buy button or the sell button. S stands for stops. I need to know exactly where I'm going to be placing my stop before I enter the trade. And T stands for targets. I need to know an area that I'm looking to get out of the market if I'm right. So in the future, if you plan to build strategies, use this CEST model in order to ensure that your strategy is rules based. And if these rules seem a bit confusing right now, no worries. I'm going to go ahead and dive into a few examples so I can help to explain the entire strategy even better. For our first example, we're staying right here on the dollar-yen 4-hour chart, and I'm going to take you through every circumstance that can happen to give us a valid trade. So here on the chart, starting off with, what do we need to do? We need to find the trend of the market. It's very obvious when we're using the 20 and 50 EMA. As long as the 20 EMA is above the 50 EMA, we're considering that an uptrend and we're looking for buying opportunities. So do we have that here? Yes, we do. We have the red line above the blue line. What's our next step? We're pointing out 2 out of 3 of these areas of value. That's what we need to see. So right now, where price is it coming into an area of value? Well, the 50 EMA can be an area of value. So the answer to that question is yes, we have one area of value. The next question we have to ask is our stochastics indicator at an extreme? In this case, if we look down here, you can see that our blue line did in fact go below our small dotted line, which is the 20 mark on our stochastics. And if you remember from a little bit earlier, if the stochastics line goes below 20, then we have an extreme case. So here we not only have our market in the correct trend, we not only have our 2 areas of value completed, but if we look at step 3, which is to find an entry, I've already pointed this out, we actually also have a valid hammer candle according to our rules. Our rules are that a hammer candle needs to have the body of the candle above the 38.2% retracement, and that's exactly what we do here. So this is how we would set that trade up. I'll go ahead and delete this and redo it for you to make sure it's easy to understand. At the close of that candle is where I would be placing my entry as soon as the candle closes. After that, we look down again. Our step 4 is to place our stops. Our stops are 1 times the ATR indicator. In case that's not clear, the ATR indicator is right up here. And right now you can see that the ATR is 59. We don't count this last little number. It's actually a tick, not a pip. So we don't count that. It's 59 pips is the ATR. So at this point, we know 59 pips is the ATR. We want to go that 59 pips below the wick of this candle. So we have 50 down to it. That means 109 is going to be our stop loss. As we stated before, for our step number 5, that's going to be finding the targets. The targets are a 1.4 to 1 reward risk ratio based on that stop loss. And it's really easy on TradingView. You can see that 1.4 right here. So that's how our trade setup would look. Let's see how this trade would have played out. As you can see, eventually pushing up enough to in fact hit our targets. And we're going to go through a few more examples, but hopefully at this point you're starting to see how simple trading can be if you just add rules and steps to your trading. We have 5 steps here that are extremely simple and that still have the ability to give you an edge over the market and to provide profits over a long period of time. And just so it's clear, this trade was an example of the 50 EMA as an area of value, the stochastic extreme as an area of value, and our hammer candle for our entry. Let's go ahead and look at example number 2. Let's go ahead and go through the steps. Step 1, find the trend of the market. Is the 20 below or above the 50? 20 is the red line, 50 is the blue line. We're below, therefore we're looking for a downtrend, or we're looking for sell trades. So with that being the case, what's our next step? Find areas of value. Are we against the 50 EMA again here? Yes, we are. We're right up against that 50 EMA. And as long as the candle that is the entry candle is still touching the 50 EMA, then I count that 50 EMA as an area of value. We're not even going to pay attention to the stochastics this time, but what I want you to do is pay attention to the next area of value, which is a support or resistance level within 100 candles looking left. So in this case, what I want you to be able to spot is right here. We have our previous level of structure support that was broken, and this level of support is, if I bring out my measuring tool, within 100 candles. So what I do is just bring out the roller tool and I put it there, go this way, and wherever this level of structure is, which is right here, now you can see that that is 46 bars to the left, which means it's less than 100 bars, right? Which means we have area of value 1 with the 50 EMA, and we have area of value 3 with a support or resistance level looking left within 100 candles. Step 3, you can already see it, I hope. We have ourselves a shooting star candle, which is our entry. So in this case, this is what we would do. We would scroll into the chart once we saw this candle, and then we would go up here, find our Fibonacci retracement, grab it, go from the high to the low. As long as that candle is below, the body of it is below the 38.2% retracement, we have a valid possible entry. We go ahead now and place that order at the close of that candle. The ATR is 21 pips. 12 plus 21 is 33. And we're shooting for a 1.4 for these examples. Let's go ahead now and click play and see how this trade worked out. As you can see, quickly pushing down to hit targets. Obviously, it won't happen like that all the time, and I'll give you an example of losses in just a second. But for now, let's move on to the final combination of areas of value we can have to support a good trading opportunity. In this example, I'm going to show you how I would actually prepare for the trade. So in this case, step number 1 is that we need to see price in an uptrend. Price is in an uptrend when the 20 EMA is above the 50 EMA. We know we have that as valid. Next up, we're looking for 2 areas of value. So what I ask myself is, what are the possible 2 areas of value I could see happen during this pullback? So as we're pushing higher and price starts to pull back, the 20 EMA can act as an area of value. The 50 EMA can act as an area of value. An extreme stochastic can act as an area of value. And a previous level of structure looking left less than 100 candles can act as an area of value. So what I would do in this specific case is go ahead and draw out my zone of major structure right here, and I would wait to see what price does. So now we have to actually move the market forward. We're prepared, looking for our areas of value. We come into not only the 20 EMA, our red line, but also coming into that previous area of resistance that is within 100 candles. I'll show you that now. If we go left here with our little measuring tool, we're only 80 bars back, which is within 100 candles. Next up, we get another move into our zone of structure, still at that 20 EMA, and then we get a big engulfing candle. So at this point, I want you to go ahead and see if you can spot out what type of trade this would be. Hopefully, you said it's in an uptrend. That's pretty obvious. Hopefully, you were also able to say that we have valid rules met for area of value number 1 and area of value number 3, because we have price at the 20 EMA along with at a level of previous resistance within 100 candles looking left. Hopefully, you also pointed out that this is a bullish engulfing bar for our entry. Let's move on and talk about stops and targets, which you should already know by now. Our stops are going to be 1 ATR below the entry candle. That's our entry candle. The ATR is 22. Down to the low is 27. 27 plus 22 is 49. And looking for a 1.4 to 1 reward to risk ratio on these examples. And there we go. After playing around a bit, we did in fact come up high enough to hit those targets. Now let's take a look at one more example before we move on to the most important part of this video. For our last example, prices in what type of trend? Well, the 20 EMA is below the 50 EMA, meaning we are in a downtrend looking for bearish trades. How are we going to set this up? Well, we're going to look now for our areas of value. We can tell that price is at the 50 EMA at the moment. We can look for stochastics extremes, which by the way, we're already in one as we're in the overbought area of the stochastic, which is above 80. And we look for a major level of structure within 100 candles. If we look left, we actually have a level of structure that was just broken right here. So this is a level of structure paired with the 50 EMA, which is also paired with an extreme stochastic. Here, if we get an entry, we have a very high probability setup because we're combining all three areas of value. And here we have that entry, which is a bearish engulfing bar. I'll go ahead and set up stops and targets. And this is what we would call the absolutely perfect setup for this trading strategy. And as a final example, here we have the perfect setup, right? We have prices pushing higher. We have an extreme on our stochastics indicator. We get that nice shooting star candle at our 50 EMA while prices are in a downtrend. Everything looks like it absolutely should work out, but it doesn't. And this is just a part of trading. I wanted to show at least one loss here so you understand that this is not a strategy, and no strategy at all is one that wins all the time, which actually brings me to my next point. If you take the correct next steps and you go back test this strategy or any other strategy, what you'll notice is that strategies tend to have times when they perform really well and make a lot of profit, and they tend to have times when they perform not so well. This is just a very natural part of trading, and what tends to separate losing traders from winning traders is the winning traders have the ability to make it through those periods of drawdown when strategies are performing less well. And to help explain this further, I'm going to draw a diagram for you. So imagine with me that we have a trader, and this trader is newish and has a strategy that breaks even over a long period of time. So it doesn't make money, it doesn't lose money. Let's say he starts with a 1K account and he ends with a 1K account. Let's say this time span is 1 year. And let's say he gets around 100 trades this year. But with this being the case, what do you think his profits are going to look like? In terms of throughout the year, what's his equity curve going to be? Well, as we all know, markets are inconsistent. They go through periods of no volatility, then periods of high volatility. They go through periods of consolidation, periods of breakouts and trends like we have on dollar and yen pairs right now. So this is what markets actually look like. It's very inconsistent. So his profits, even though he has a strategy that breaks even, so figuratively it should go from 1K to 1K, his equity curve isn't going to be linear like a straight line. This is what his equity curve would look like even if he's a break-even trader. He would have times when he was doing really well, times when he did badly, times when he kind of broke even, and his equity curve would look like this until the end of a large sample size because of the inconsistencies in the market. Now, this was an example of a trader that's completely break-even and does not have an edge over the market. Let's do an example of a trader that has an edge. What would that look like? Well, that would look something like this, right? We would have a starting point that was lower than the ending point for this trader. That's pretty obvious. So let's say this trader started with a $1,000 account and he made 100% in a year. He had a crazy good year. So he went from 1K to 2K within that year. The problem with most traders is this line is what they expect that equity curve to look like. When in reality, the same markets are what we're trading, even though we have a strategy that has an edge, that's proven to make money in the past, and that's proven to give us profits. Those profits aren't going to come in a linear straight line. Because of the inconsistencies in the market, this is what those profits would likely look like. Our path to getting to that 2K or making that 100% is not going to be a straight line. And what happens is so many traders have an issue dealing with these periods of drawdown that push them below that linear line that's our average of what we make throughout the year. But in reality, with markets being inconsistent and constantly fluctuating, we cannot expect our trading to just be a straight line from point A to point B. It's going to be more like mountains and valleys that have a slope to the upside if we're trading a profitable strategy. And that is just the natural part of trading. The faster that you can recognize that and understand it, the easier your journey to profitable trading is going to be. Hopefully that diagram helped you to make sense of what a trading strategy looks like in terms of an equity curve over a long period of time. Now I want to go back to our rules of this strategy. As a quick review for this strategy, we're looking for price to be in trend based on the 20 and the 50 EMA. We are then looking for 2 out of 3 of the areas of value I have listed here. After that, we're going to be looking for an entry. Our entries are the 2 candlestick patterns I've shown you earlier in the video. Stops for these examples was 1 times the ATR indicator below and above the entry candle, and targets for these examples was a 1.4 to 1 reward to risk ratio. Feel free to mess around with the stops and targets, mess around with any of it you would like, turn this strategy into your own. But right now, I think it's really important for you to understand that a trading strategy does not equal profitable trading. If you remember that diagram I was showing you, those ups and downs, the peaks and valleys, the reason traders tend to have such a hard time when their equity curve is doing this is because of one of 3 reasons. They either have really bad risk management that's causing their peaks and valleys to be too extreme and causing emotional turmoil. So the first reason for that is going to be risk management. Another reason traders get really uncomfortable during this is because they have not back tested their trading strategy, so they have no idea if it actually has a positive expectancy over time. So these are the ways you can fix those emotional problems you're having. So the second thing, if you have a decent risk management plan, would be to back test the trading strategy to give yourself more confidence in it, whatever you're trading, whether that be the strategy you learned in this video or some separate strategy. And another reason that emotional turmoil takes place is because of a lack of knowledge of trading psychology, which is just your ability to stick to your plan. Again, the market will test you with drawdowns and valleys. And I know all you want to see is peaks. Trust me, I wish I could tell you that trading was a straight line straight to the sky, straight to the moon, if you will. But that's not how trading goes. And that's the reason 95% of people fail, is because they're lacking either a strategy that makes money over time, a risk management plan that keeps them comfortable and emotionless during their trades, or a knowledge of trading psychology and the ability to be disciplined to that strategy and that risk management plan, even if they get greedy and want to risk more, or even if that strategy isn't working right now because it's going through a period of drawdown. Switching strategies is not the answer if you have a strategy that's proven to be profitable over time. Learning how to trade from YouTube is a great first step, but if you're ready to take that next step and you want to learn from an organized university style course that'll teach you everything from the basics to extremely advanced strategies, then we do have some space available in the TTC Forex University. With the TTC Forex University, you'll also be receiving 3 to 5 email analysis per week, which are trades I'm actually taking based on the strategies you're learning in the course. You'll be receiving the Pro Trader Report and a Best Setups video each and every Monday, talking about the pairs and structure levels I'm paying attention to personally for possible trades. You also receive email coaching support, so it'll be me personally answering any emails you have, or any questions that you have rather, about trading in general or about the course. And on top of all that, the university also comes with a risk-free money-back guarantee, so if you're unsatisfied for any reason at all you have to do is send us an email and I'll make sure my support staff gets you a refund ASAP. I don't think you'll need it though, so if you're interested in the TTC Forex University and being a part of that, we'd love to have you. It's the first link in the description, and also you can go to www.ttcfxuniversity.com. If not, that's completely fine too. Just be sure you're subscribed here by clicking the little red button and the notification bell. Be sure to click that like button if you enjoyed the video. Comment if you made it to the end, and I'll try to like every comment that says you made it to the end. Thank you for your dedication to yourself, your future, and to learning how to trade Forex. I will talk to you guys in the next video. See you soon.